Welcome back. In this business finance lecture, we shall go over study problem 9-15 in page 300 from the 8th edition of our textbook. Let's have a view of the problem. This is a rather long-looking problem. In the first part of the problem, we are given some information about our company, and we are now in the middle of the problem. We are also given the balance sheet of our company. Now recall that the left-hand side is basically the assets, and the other side will provide you with liabilities and equity. So basically we have two main items on liabilities and equity, and we have the usual asset items listed as well. So this is basically the accounting book of the firm. Now this is the books are followed by some other information, including the fact that the stock is currently selling at book value and the bonds are selling at par. So this one is very important information. So basically what this tells us is that we can go ahead and make the calculations based on the figures provided in the accounting book. So basically the accounting book reflects a true valuation, market value of our company. In addition, we know that the stock return is 15% and the bond return before tax is 8%, or you can consider it as a before tax cost of capital in that case, and the tax rate is given as 34%. The question has two parts now. In the first part, knowing that the accounting books reflect the true value of the firm, we need to come up with the weighted average cost of capital, the WACC, for this firm. And the second part we will also have a look at next. So let's go ahead and rewrite the givens in our problem, and then let's go ahead and solve it in the next page. What are the key ingredients given in the problem? Cost of equity is 15%, whereas the cost of debt before tax, so let me put those two initials as well, before tax cost of debt is 8%, and we also know our tax bracket is 34%. So combining these two results, it should be pretty straightforward to figure out what would be the after-tax cost of debt. So it would be basically 8% times basically 1 minus 0.34, and this should come out as 5.28% after-tax cost of debt. Crucial information: market to book accounting book ratio is equal to 1. We can go ahead and produce a table. The table will obviously have two rows, capital items, so let's say capital items. We have debt, long-term debt, and we have equity, common equity. So because the book value reflects the true market value, we can go ahead and copy those numbers. So the debt figure in our accounting books show up as $12,590,000, whereas equity was valued at $18,885,000. Now we will make use of these figures, liabilities and equity for that firm, which is $31,475,000. And now it's time to calculate the capital weights. Basically, to calculate the weight is simply, all I do is to divide debt by total capital, and this should come out as roughly 40%. Whereas you do the same thing for equity as well. You divide equity by total capital, and you should get 60% as your weight of equity. And make sure that to realize that the sum of these two numbers should always give you 100%. There might have been other capital items as well. In that case, there might have been 3-4 different type of financing, but regardless, you always get the total of all financing weights should be 100%. Now, we already calculated the cost of debt, after tax cost of debt for the bond, so I can say cost of capital. For the bond, that number is 5.28%. For the stock, that figure is 15%. Now, in the next step, pretty much the last column that we need. We now need to multiply those two columns. Column, we can, let's give names here, column 1, column 2, column 3, column 4. So I will go ahead and multiply column 3 and 4. So that's basically a product here, line by line product. And so basically we are multiplying 40% and 5.28%. This number should come out as 2.112%. And we do the same thing for equity. 60% times 15% comes out as 9.00%. Now in the final step you add these two to receive 11.112%. That figure is the number that we were seeking. This is basically the company-wide cost of capital. So therefore this is your WACC. WACC is equal to 11.11%. So I just rounded it to 2 decimal places of accuracy. So that solves part A of our problem. For part B now, the only difference is we still have the other figures the same, except that there are some changes here. So first of all, we are told that the market to book ratio is no longer 1, but rather it is 1.5. So that's one thing, one change. And another change is the cost of equity now. Because of this market to book value ratio being greater than 1.0, cost of equity now is relatively less expensive at 13%. So basically the investors, the stockholders have lots of confidence in the future potential, earnings potential of our firm. So we should be able to so these are capital items. First, capital items column. In this case, our capital items column again are debt, long-term debt, and then equity. So here we should be careful. The market value of debt has not changed. So it is still I believe it was $12,590,000. However, so that's important, the market value of equity has significantly increased. It is now 1.5 times. So let me open a side box here. And so the market value of equity is equal to the book value of equity times the ratio. So the book value, if you recall, was 18.85 million. So you multiply it with a 1.5 ratio, market to book value ratio, you get that the market value of equity is now $28,327,500, and we plug that number in. So $28,327,500. And now we can get a new total. The new total would be standing at $40,917,500. And from there we can get our weights. And in this case, the weights will be slightly different now. For the bond, the weight is now lower at 30.77%. Recall, in our previous calculation, this was 40%. And the weight of stocks has increased to 69.23%. But the total still did not change, still 100%. The after-tax cost of capital, after tax for the debt, again it didn't change, 5.28%. However, for equity, it has reduced to 13% now. And now in the final step, we need to have a look into their product here. And the product of weight times cost of capital for the debt would be simply 1.62%. And the same calculation for the equity will yield a 9% cost of equity. And so when we add these two together, we realize that the company-wide cost of capital has reduced to 10.62%. This is our weighted average cost of capital under this new scenario. So that figure stands at 10.62%. And that finishes our lecture. I hope you enjoyed our video and hope to see you again in our next lecture.